All right, welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at ticker BCC, Boise Cascade. Pretty interesting company in the building materials and somewhat in the lumber and wood products space. Before we get into that, we're going to take a brief look at our watch list that we have here. Made some actual major changes over the last couple days to a few different ways that my evaluations kind of come out. So I kind of wanted to take a moment to kind of discuss some of that, which it gets into a little bit of a topic that is a little bit sensitive for some people, depending on various people's, I guess you could say, theoretical perspective when it comes to valuation, because we're going to be talking about risk measures, in particular what is known as beta and how I use it in my valuations, because I made kind of a major change to the way I'm calculating my beta, and so that kind of has some major effects to a large amount of the valuations we did here. Like I said, major changes to my valuation as here. It's kind of hard to maybe pin out specifics of what has moved where, because there's actually quite a lot of movements in the watch list since I basically changed the way that betas are calculated. That meant a lot of discount rates have changed, and that has a lot of downstream effects. So kind of hopping over here to my spreadsheet where I have my betas for industries, which I get this data set primarily from Aswath the Motoron, but I do a lot of adjustments to his kind of methodology for myself. But basically what his methodology is to take the average betas for industries, and he has data sets of various amounts of companies in various industries as listed right here. And then he takes the beta for those companies as well as the average debt to equity ratios, tax rates, to work backwards to essentially figure out what an industry's beta would be if it had no debt and no cash, to find out just like a pure unlevered beta. And then using that metric, you can then adjust company specific leverage levels to figure out what a specific company's beta is. I myself, for my methodology, I essentially use the 5-year average of this particular unlevered bottom-up form of beta. And then I also take that particular number and average it with an operating beta, which is a standard deviation in operating income over the last 10 years, weighted against an average or median metric thereof, which gets you a number that kind of is reflective of a beta, which you can see there's actually a lot of numbers missing from this particular column here, which represents basically the industries from which the sample size was too small in order for me to do this. So I use an average unlevered market beta mixed with an average operating beta, which is an operating income standard deviation risk metric, as well as a market-based beta, which basically assumes that all companies have effectively the market beta of 1, but it's unlevered and then relevered for the industry specific. So this is an industry specific metric of that. So essentially I have 3 different methods of calculating an alternative beta, of which I take the average of those and then I unlever them, and that's what I call my unlevered composite beta. It's a little bit of a complicated methodology, but the reason why I do this is partially pragmatic, which is to make it so that these metrics shift relatively slowly year by year, because if it has too sharp and too large of swings year to year, then I think that means the theoretical underpinnings of the metric don't really match up to what I'm trying to accomplish, which is to get an industry specific risk measure that represents the industry over a relatively representative longer period of time. Yes, industries change over time, but it shouldn't have a drastic change year to year. It should be a relatively slow shift, and most of the numbers themselves should be reflective of the financial and operating leverage as we were talking about. So I made some changes to that, like I said, in the last 2 years specifically. There was an issue I was having with the operating beta and making the actual average of these numbers come out to a number that approaches both the unlevered and levered averages betas of other metrics, which I managed to do that here. You can see that the median coming out to 0.82, which is within half a standard deviation of 1, and 1.32, which is likewise to the upside. So that is reflective of what you can see over here, which is a little bit more typical for the levered composite to see an average of 1.1 or so, which makes sense because a typical average beta is about 1.1, and then the market metric should be about 1. So therefore you should get about 1.1, 1.2 1.19 is a little bit high, but not necessarily too much because it's an average versus the median, as you can see here. So essentially what that means, like I said, is that I've readjusted all the betas in all of my valuations, and I went back through my watch list and I essentially reapplied these new betas to them. But I didn't just stop there, because if I'm going to change one thing in my valuations, I might as well go back and readjust a lot of other assumptions. So for all the companies in my watch list, I also readjusted my revenue assumptions and my margin assumptions and capital assumptions and the default risks and all those things to make sure that all the assumptions are consistent with each other as of when I put them in. And then, as I had talked on the last stream, I was also talking about removing some of the older valuations that I wasn't looking to update. So I did remove like 5 or 6 companies from the watch list that were particularly old, and I wasn't likely to revise them in the near future. So with that, we end up with our current watch list as it is here, which is a total of, 74 companies as it currently stands. The highest value score I have is 1.5, which that company is more than 100% of upside, 28% expected return. And the worst company in the portfolio has a negative value score of negative 0.58, which is supposed to have 69-70% downside with a negative 13% COGR. So a pretty wide range of companies' valuations and fair values. But it is worth noting that if we come down here to the kind of like statistical metrics that I have listed here, you can see that the average upside that the companies in this watch list have is about 0. So essentially, the average between all the valuations I have here is that it's flat. It's effectively 0. The median a little bit downside, 4%. And you can see that the average expected return is about 8.95%, which comparing to that to, for example, my current market expected return. Well, I mean, if I risk adjust, my market expected return is like 4.5%. But if I just take the discount rate based off of the earnings as expected, it's about an 8% expected return currently. So the idea that my watch list gets to about a 9%, that's not too far off from what you might expect if you have a representative sample, which is what I'm trying to show that these statistics represent, is that if you have an average upside that's flat, that means you perhaps picked a representative sample of companies and that your valuations reflect that. Because if you just kind of pick a random sample of companies, in my opinion, you shouldn't really find more of them to be up or down, relatively speaking. Obviously, it depends on when in the market you're picking, because sometimes the market's more up or down. But if you pick any random time in the market, you should be just picking companies. You should theoretically not really be finding 50% of the companies to be undervalued, so to speak. Or you shouldn't find 50% of the companies to be overvalued, unless the other half is also undervalued or overvalued. But my point is, you shouldn't have it lopsided too heavily one way or the other, because if so, there's probably a problem with your methodology. If you're finding a ton of companies to be undervalued, you might be not being conservative enough. And if you find most of the companies to be overvalued, maybe you're being too conservative, So I think that finding that with my watch list as an average of basically 0, I find that to be pretty good. Hey GT, welcome to the chat. So anyway, like I said, I'm not going to get into a lot of the specifics of which companies have moved up and down in the list. I did take some screenshots once I finished doing all that work last night. It took many hours to do all this kind of reconfiguring, but I will probably post those screenshots in the Discord. So if you are not part of the Discord, you should probably join that if you want to perhaps peruse some of the new valuations in line with each other. And with that, it would also be great if you are watching this either live or on the replay. If you haven't already, please give us a like. It helps attract new viewers to the channel. If you haven't already subscribed, please subscribe to the channel. If you'd like to join the Discord, it's the pinned comment in the chat below, as well as it is in the description, so you can join that to become part of the discussion that we have there on various topics. So now we will get into the actual valuation, discussing Boise Cascade. Getting into some of the company specific information before we do it. This valuation in general, I will say before I kind of get into it, is going to be relatively simple and top down. I was kind of mostly doing this valuation partially because I wanted to compare it to some other companies in the watch list, other companies in the home building and building material space. So I definitely didn't take a super detailed approach to it, but either way, we can go through the numbers and kind of take a look at the potentials that it has. I have all their websites listed here. They're a US company founded in 2004. Their current CEO, Nathan Jorgensen, I actually didn't manage to find out too specific information about when he was elected and joined. Not that it's necessarily hard to find, but I kind of got distracted looking into some other specific information and never quite got around to that. So that can something else some people can find. As I had already said, the industry they're in is the building materials industry. Top major customers, well, really they have a pretty wide varied set of customers, but two major ones that can be pretty indicative of issues in their sales being Home Depot and Lowe's, because obviously being in the building materials industry, they're going to have a pretty major downstream effect, being that those are two major buyers of building material products. Top competitors, we have Weyerhaeuser, Georgia Pacific, LPX, another company that we did do a valuation of. Many other companies that are competitors for them in the home building space, whether it's in various plywood types of applications or harder lumber parts of their business as well. Top suppliers are basically also their competitors simultaneously, Georgia Pacific and LPX. Lots of other suppliers as well. It's a pretty diversified company as far as the parts of the economy it interacts with. They did just report the numbers, but the next report that they are expected to have for the third quarter is on November 1st. Excuse me. They didn't provide revenue guidance that I could find in the transcripts or in their filings. They did have not revenue guidance in particular, but they did particularly have a huge focus in not just the quarterly numbers in the presentation, but also just multiple parts of their discussion. They focus very much on the U.S. housing starts, talking about as it's currently expected for 2022 to be roughly flat year on year. The last quarter that they just had being up a few percentage points from the quarter last year. But again, year on year, it's supposed to be roughly flat, with 2023, most economists projecting to be down double-digit percentages. So that you can take as kind of being similar to revenue guidance for them, since that's going to have a huge dramatic effect on the revenues. Analyst expectations, 5 analysts are guiding for 5.2% revenue growth in 2022, with a negative 10% in 2023. 5 analysts also guiding for that. Analysts guiding $20.37 of adjusted EPS in 2022 for the same 5 analysts. There's 6 analysts guiding for $9.81 in 2023. So a huge drop expected in the EPS. $5.42 was a trailing 12-month dividend. They did pay out a very large special dividend. And I found in multiple parts of their presentation and their transcripts that they kind of give indications that they are very much in favor of doing large special dividends in the future if their capital on hand allows for it to do so. The forward dividend, as it's currently projected, is a quarterly dividend of 12 cents per share, so 48 cents yearly, which comes out to be a little over half a percentage point per year. So that kind of goes in line with why they're very much in favor of doing large dividends, as they like doing a small dividend that they can very consistently grow over a long period of time and supplementing that with larger dividends. They do, however, also have buybacks authorized. Currently, 2 million shares is the authorization, which is always interesting when a company has the authorization in share form rather than in dollar form. If you convert that accordingly to with the current share price, that ends up being about $143 million of authorization, which would equate to about a 5% yield. So you can see so about a 5.5% yield of authorized material. They do make multiple statements talking about how the most recent large addition to the authorization is not so much about using it in the near future per se. They like to have a large authorization available to them to do opportunistic purchases. I didn't do a close analysis of past buybacks to see at which prices they had purchased it, but the way in which they're speaking definitely gives me confidence that they're the company that definitely is more likely to do buybacks when it's at lower prices. So that's always good to see, and I see they have that authorization in place. Current inside holders, not very large percentage, a little less than 1% is held by insiders. However, there was a pretty large increase in the last 6 months, about 79-80% increase. So not a huge amount of people on the inside doing a large amount of holdings, but at least they are purchasing for, or at least being granted purchases for one reason or another in the last 6 months. 94% of the float is held by institutions. 2.5% of the outstanding shares currently is short. As of a percentage of the float, that comes to 3.57%. So some shorting going on in the company, but definitely nothing very substantial, nothing too major to think of as a negative or as a positive as I typically do. Short ratio at 3.45, which is relatively typical, nothing too short or too long in that category. The 3-month average volume being 0.38 million shares, and then the last 10 days has been 0.33, so a little bit lower in the last 10 days, but perhaps not as dramatic of a bring down relative to the past volumes compared to a lot of the other companies that we've done most recently. So before we get into the company financials, I'll do a little bit of an overview of some of the details in their investor presentation. Nothing too detailed, just a few slides in particular I kind of wanted to point out. They go into a lot of specifics. I mean, I kind of slid past it here. You can see the Lisa graph showing the percentage of their sales in the building materials versus the wood products part of their business. So they are mostly building materials with a little bit of kind of lumber production. In the last 12 months, however, their adjusted EBITDA, you could see a huge portion of that coming from the wood products, which I think was reflective of just kind of the generally high value commodities have been able to get in terms of profit in the last 12 months, comparative to, for example, the inflationary pressures on more produced products. So you can kind of see that reflective in the difference between the sales and EBITDA numbers for those parts of their business. You can see the geographic disbursement of the distribution and production centers that they have for the wood products and building materials parts of their business throughout the United States. So pretty good to look at that. And then, as I had kind of said before, a huge focus in a lot of their topics of discussion on the single family housing starts, and like using that as a metric for guiding the business demand that they have. And they're talking about the last 20, 30 years and the overall growth of the family housing starts, and how we've had a deficit basically ever since the crash after 2008, and a lot of progress into that. Then they get into a lot of ESG stuff, which I'm gonna kind of skip past, definitely not as focused on. Then they also show a lot of the work that they've done on capital allocation. Where is that down here? Actually, before that, I'll show, here's the slide they had with key customers and suppliers, showing a huge kind of breakdown of like I said, a very, very diverse set of customers and suppliers that they have. I have named a couple of the names on the company information sheet, but obviously there's lots more that could be said, especially since they're pretty diverse in the building materials aspect. It's not just wood products, but also a decent amount of non-wood metal produced products. And this is what I was saying about the capital allocation. They definitely have a large focus on delivering capital to shareholders, both with the regular dividend and the special dividends, as well as the share buybacks, and lots of focus on future potential M&A, bringing their net leverage down. They definitely are in a net cash position, which is always good to see. So with that, we can move into looking at the segmentation of the valuation itself, which is kind of relevant to, like I said, I had changed up the risk metrics we were using over the last couple of days. So when I was working on this valuation, was part of what made me decide to go back and do that, just because I was seeing some of the discrepancies I was seeing between certain sections of the business, certain industries, and had risk metrics that didn't really reflect, I thought, the last couple of years of the risk in their business. And I had thought about this about some of the other industry risk metrics I was using, but I decided to go back once I was doing this valuation and address that now. So anyway, wood products being about 9% of their business, and the building materials being about 90 to 91% of their business, that gives them an unlevered weighted beta of 1.15. Sales capital expectations of about a 3, and a net margin for the last 12 months of 10.5%. They do all their business in the United States, so with that we end up with a levered beta after adjusting for their debt to equity ratio of 18 to 19% of 1.31. And that brings me to a cost of equity of 9.67 for the company as a baseline. That's off the back of $550 million in listed debt and lease liabilities at a weighted average maturity of 8 years and an interest rate of 5.17%. And that brings their cost of capital to 8.74% after adjusting for the market value of the debt. So with that, we can go into the financial history of the company. The 10 years that we have over the historic period, they went from $2.8 billion in sales to $7.9 billion in 2021. You can see that they had been moving at relatively high single-digit sales growth for the first 5 to 6 to 7 years or so of the business, moving through a little bit of a slower period as we went into 2017, 2018, 2019, bringing it down into kind of mid-single digits. Hey, Nukit, welcome to the stream. And then going into 2020, they started to have an explosion in their sales, as with many companies in the industry, 17 to 18% in 2020, and then 45% in 2021, bringing the CAGR for the last 5 years up to 15%. So obviously that 15% is not exactly probably super sustainable over the long run. Maybe taking kind of an average of the CAGRs on a rolling basis that we had prior to 2021, you can see that the average for that was about 7-8% or so. We can take a look at the gross margins for the business over the same time frame. Basically looking at gross margins as an average prior to 2020. They had an average of about 13.5%. Hey Jack, sorry if I'm late, but how are you accounting for lumber dropping like 50% since these last earnings numbers? Well, I'm doing my projections on kind of a longer term scale from 2021, and to be fair, they only have 9 to 10% of their business associated with lumber. The rest of it's in building materials. So the way in which lumber prices actually affect their bottom line is a little bit different than a more of a pure play lumber producer. I didn't do a lumber price correlation for this company like I have with like lumber specific producers. But what I am going to do is essentially simulate a pretty large drop in revenues for the 2022 numbers. As I had kind of said at the start of the stream, the current expectations is for their revenues to be relatively good for 2022 and the drop to actually come in 2023. But I am, because of my baseline being off of fiscal numbers of 2021 and moving forward, I'm just going to simulate that into 2022 and then also have relatively low margins for that. But we'll get into that when I finish the financial history. I'm getting a little bit ahead of where I was. Anyway, so as I was saying, the average gross margin for the years prior to 2020 was 13.6%. And then the average gross margin, or we can just really think about the most recent gross margin of 20.5%. So if you kind of think about the difference there, it's about 6% difference. So perhaps you could see a 6% drop in margins if the gross margin was just to come back down to the margin it was at previously. And then obviously the margin they currently have is about a 9% margin in the most recent years. So if you think about a 6% drop from there, that would bring them down to like a 3% margin. However, there are other factors to be taken into account, which I did kind of go into and account for, which is that, for example, if you take a look at the SG&A as a percentage of sales, that has also dropped as a percentage of about 1%. So you could say that if we had dropped to 3%, you can maybe add back another percent to get to 4%. And then they also have had their interest rate and debt levels relative to assets drop about to take up maybe about another 1% or so. So I think that while their current margins from 2021 was at 9%, it's pretty reasonable to see them come back down to maybe a 4% over the long term. What's the correlation between lumber and general building materials? Like the entire industry? I'm not entirely super sure. I haven't really looked at the entire industry that way. The cash flows look like every other lumber producer is why I asked. Massive increase lately. Yeah, sure. I mean, there is going to be a significant correlation there, but I just didn't choose to actually do a lumber revenue correlation specifically. There is a huge amount of correlation to it, but it doesn't mean you definitely have to actually do a correlation in your valuation specifically. I'm choosing to just simulate it the way I'm going to simulate it, which is, like I said, a drop in revenues and a drop in margins. So that's just the way it's going to be done. Like I said, I agree that they're going to have a drop in that way. I don't disagree with that. Just I didn't necessarily do something super special. Like I said, I just simulated a drop in revenues and simulated a drop in margins. I don't know what else I necessarily need to do for that. But anyway, so getting into the cash flows of the business. Well, I guess I didn't finish with the margins. I was saying I was going to go from maybe about 9% margin to kind of 3 to 4% margin. That is worth noting. Like I said, that's comparing against the 1.7% margin that they had kind of averaged 2019 prior to that. So if we added maybe 2% as a baseline for the SG&A and the debt costs onto that, that would kind of bring you to 3.75%. So 5%, 3.75%, kind of averaging between those numbers, you maybe get 4.5%. It's kind of like I said, a guideline, which, as like I said, like I can see here, I'm using the 9-year average, which is 1.3 as my baseline. So that's part of how I'm simulating this, is I'm simulating the 3-year average of sales as my baseline, which is going to bring a 20% drop in sales. So going from 7.9 billion in revenues of 2021, which, like I said, they're expected to actually be a little bit higher than that in 2022. The current expectations being, was it 8.35 billion or so. So if I'm simulating it going down to 6.3, that's my drop in lumber prices right there, as well as going from an 8 to 9% margin down to a 1.3% margin. So that's also my simulation of drop in lumber prices. LPX is similar to this one, correct? Yeah, pretty similar. The LPX is a little bit more focused on the building materials, but yeah, they're in the same industry, roughly speaking. they're suppliers of each other, customers of each other, competitors of each other, kind of all simultaneously. And which I had kind of mentioned that a little bit at the start, as well as some of the other players. So getting into the free cash flows to equity, you can see for the first 5 years of the historic period that we have, they have an average of $74 million per year in cash flows, and the amount that they pay out to their shareholders is actually negative due to a large negative equity cash flow that they had in 2013. So that's really just a fluke one-off year right there, but overall you can say that means they're not really overpaying the shareholders, but with a relatively small payout ratio except for the special dividends, that would make sense. The average cash flow they had for the last 5 years on average was $201 million per year, comparing that to the cash flows that they paid out, which is $85 million or so. So yeah, really not excess amount of payments to the shareholders, even with the special dividends that they paid out in 2021. Because even with that one large special dividend, they didn't even pay out all the cash flow they had even in that 1 year. They missed earnings not too long ago, LPX that is. Yeah, I didn't look at LPX's most recent earnings. I did the valuation of them some time ago, and then as I was saying at the start of the stream, I was kind of updating pretty much all of my valuations yesterday. So I did take a look at the LPX valuation a little bit, but I didn't like go in depth into their earnings to think about it. I was kind of taking more of a broad overview of all of my valuations, kind of to see if there was discrepancies in kind of the macro assumptions I was making therein. But anyway, looking at the returns on invested capital for the first 5 years of the business, it averaged about 14-15%. For the next 5 years, it's averaging about 22-23%, relative to obviously the most recent year being 64%. So very, very high there. Just a heads up, I know you're not using lumber prices, but they're down like 50% since last year. So I expect revenues down at least 30% on average across the lumber makers. Yes, but again, this isn't a lumber maker. This is a company whose sales are relevant to when lumber sales are made. I'm aware the lumber prices are down that much. That's why I started buying a lumber producer in the most recent period. Like, I don't know if you think like I'm unaware of this. 20% expected revenue drop right here. I've said it. 20%. It's right here. 20%. You're saying 30%, so maybe it needs to be higher than that. But like either way, that doesn't make that big of a difference. I already simulated for the lumber prices dropping. I'm aware of where lumber prices are. So it's like, I don't know if like I've said it. I'm aware. I understand that. Sure, but like I said, I also have their margins dropping down to 1%. So I would say between the two, like I have the expected net income for the next year is 100 million versus 700 million in 2021. You know, like, is that not a significant enough earnings drop? Like, yeah, you can maybe argue the sales drop should be larger, but at the end of the day, it's the bottom line that matters, right? So it's the combination between the two that matters. Maybe it should be negative. Like you could argue that maybe I could take this further and it should be negative. But that's what I was saying. Is like, yeah, like I said, you could argue that this should be 30%. You could argue it should be 40 or 50%. But at the end of the day, it's the combination between the two that I'm simulating. Like I said, you could argue that it could go negative. I could simulate that if I wanted to. Though if with negative, you could also make it larger than 1%. So I mean, you can do lots of things here. I will say, I've got you. I've got it, man. I appreciate you bringing it up. Not trying to be like not trying to be like, oh, I'm like upset or something. But it's like, I got this. I know what I'm doing. I already covered for it. Oh wait, that's 0.1. Let's say we simulate this to -1. That would bring it to like a -3%. I don't know. We can play with some of those things. That lowers the short term kind of valuation of it, but as you can see, like the kind of doesn't change the valuation too dramatically. It changes the short-term profits a bit depending on how you think of the current discounting. Fair enough. Like I said, I just hadn't gotten to that part, so you were kind of getting ahead of me. I was like, I'm still doing the financial history part. It's like, wait till I like actually say what I projected. It's like, I know what's happening in lumber. I'm paying attention to it. I pay attention to it very, very closely. It's like, that's why I've been buying Interfor. It's like, I'm definitely aware of lumber. It's part of the reason I chose to do this company in the first place, is because I think of it as, well, I mean, because that's kind of, I've been looking at a lot of the companies in this space kind of the same way, which is that the market knows that those prices are going to come down. It's just a question of whether or not the market's priced in enough. Anyway, getting back into it, we can take a look at their their balance sheets, which as I kind of already said, I haven't taken a look at the most recent quarter, so it could be a little bit different depending on how much cash they've decided to pay out in the last quarter or so. But overall, you can take a look at their current assets as basically exploded from 500 million or so in the first year of our 10-year period up to 1.8, 1.9 billion or so at the end of 2021. The average for the last 5 years being 1.2 billion, and the average for the first 5 years being 700 million. So even over an average kind of period, they've moved up very dramatically. You can also see that the total amount of cash as kind of like a percentage of the current assets has moved up pretty dramatically as well, with 700 million being kind of the average current assets and 123 million in cash being the average there. You can see it's kind of like 15% maybe, versus you can see it's ending with 750 million in cash versus the 1.8 billion, which is more like 30% or even higher. So a large amount of the current assets coming into cash. If you also even just subtract out the cash from the current assets, you would end up with like 1.1 billion. You can compare the 1.1 billion to 1.2 billion in liabilities. So most of their liabilities, even after you subtract out their cash, can be covered by just the current assets alone. What's the net tangible book value? Well, I mean, obviously different websites use different metrics to calculate it. I kind of have my own version of calculating tangible book value, where I kind of count like different percentages of, like, I discount each item a little bit differently. So what I come up with is about $14 per share in tangible book value. The total book value per share is 34. And this again at the end of 2021. So I don't know if it's shifted a little bit in the last couple quarters, but so normal book value about $34. The way I like to calculate tangible book value, it's like $14. Like I said, it's not like that much book value compared to the share price or the market cap, but it's more of like a well financed company. It's not like trading cheap relative to book value, but I think its book value is well covered for its liabilities. That's the factor I'm trying to point out. It's like 1.8 billion, subtracting out all the liabilities, you still end up with about 600 million after all the liabilities, and that's most of the cash. So it's like you could subtract out the cash from total assets, and you end up with, what is it, a 1.7 or so, and then subtract out all liabilities, and you still have equity. So you can take all the cash out of the business, which is substantial, and then you would still have a decent amount of book equity left over. So it's just a really clean balance sheet. It's not trading cheap relative to its balance sheet in any particular sense. I mean, it's not trading bad against its balance sheet, but it's not trading like liquidation cheap or anything like that. Not even close. Anyway, so now we can get into like the projections. Like I said, we'll start at the top. So yeah, I did use the 3-year average of their current revenues as kind of like my baseline, and then I have it growing -4% in the worst case scenario to 12% in the best case scenario, which gets us kind of like and then I have it leaning towards 6%. So that kind of gets us, like I said, this kind of mid single digits growth, which is what I expect them to kind of maybe go back to once they've kind of rebased their revenue, so to speak, which was kind of a little bit similar to what they had been doing prior to 2020, 2021 for the kind of the rolling average period. Like I said, I am simulating approximately a 20% decline in revenues. Like I said, this valuation is basing off of the fiscal 2021 numbers, so it's a little bit lagging, because as I had said, they're currently expected to get like 8.3 or so billion in 2021, and then the drop is expected in 2023, which is worth noting. Like you're saying, lumber drops 50%. Maybe you could expect builders and lumber producers to drop 30% in revenues. And like for other valuations, I've definitely used some more sharper numbers, but even the analysts definitely haven't woken up to it. I definitely agree there could be some serious sharp drops in the revenues. But part of the reason I'm also allowing for the 20% alone is because of the fact that we're not actually building in the profits of 2021 into the company. Because like I said, it's a little bit of a time lagged valuation because I don't have it rolling off the 2020 the trailing 12-month 2021 numbers. And so as a result of that, by not allowing the 8 billion into 2021, I'm effectively not allowing a certain amount of profit to accrue to the company. So I think that balancing out the 20% is kind of like giving them a benefit, but it's also it's balancing out the fact that I'm essentially not punishing them as much as that they ought to for that one fact. So 20% decline in the most recent year, like I said, then growing at that typical rate. By the end of the projected period, I expect them to get back to around 7.6 billion or so in revenues, which would come out to about a 1% decline per year for the 5-year period on net overall. Like I said, with the the margins. I kind of played with the numbers a little bit here, and that kind of changed the valuation a little bit, which I'm fine with leaving that there. I don't really mind one way or the other. I liked this company and thought it was an interesting valuation, but even with the relatively rosy valuation I was having here, I wasn't necessarily feeling that interested in buying it. So I'm okay with kind of adjusting it and not thinking too much about it, because I was kind of just trying to get an idea for this company to expand my knowledge of the space a little bit, was kind of my intention with this valuation. But so whether or not you think that maybe they could just achieve, as I had kind of originally projected, maybe 2% or 1% margin in the next year, or maybe you do think that they would have a negative margin, as I was kind of just playing with there, that changes the valuation a little bit, but I don't know, I'll leave it at maybe the negative 3%. I'm kind of comfortable with just leaving it as that. That's my ample margin of safety IMO. Yeah, well, it's always good to kind of have a conservative estimate of things. Oh yeah, so for the margins in the kind of the terminal year though, I do have it ranging from 1% to 6.5%. That gets us a median of 3.75%, and then I have it leaning towards 4.5. That kind of gets me an expected number of a little over 4%, which, like I said, different metrics of kind of thinking about how they've improved their operating margins relative to the average prior to 2020. I came up with 3.75 with one kind of way of estimating it. I came up with 5% as another way of estimating it. The average between those two metrics right there gets me a little over 4%. I actually got it a little bit lower than the average between those two metrics. So I think this is a pretty good estimate of a terminal margin. Like I said, 8 to 9% is definitely not sustainable. But they have clearly improved their operating metrics more than the average 1.7% that we get prior to 2020. So I feel comfortable with giving them a little bit of a boost to that historic margin, but yeah, no more than maybe about 4.18% as an expected number. And then so with that, we also have capital expenditure assumptions. Looking at their sales capital ratio, you can see that that's a pretty strong sales capital ratio, which kind of goes well with the relatively low margin that they've had over their history. It's pretty typical kind of arrangement you see with a lot of companies. Overall, the entire historic history that we have, the sales capital ratio averaged 5.64% or 5.64 or so, and that compares to it currently being at 6.9. So maybe take like the average it was without the 2020 2021 numbers, we get 5.48. So not really any difference actually if you count the 2020 2021 numbers. Maybe think about like the last 5 years average, still about 5.49. So you kind of end up with the same average no matter really how you spell it, which is kind of nice. Means they have a pretty stable I guess capital needs relative to how they can grow their business in sales terms. So either way, I end up with a range of 3 to 8 is kind of the range I get, because that gets me this midpoint of 5.5. And then I have it pushing up towards 6, because like I said, it's currently actually close to 7. We are expecting their sales to decline significantly, so that would drop it back down. But whether or not they would also be purchasing their shares, which would decline their capital base, how much that ends up on balance, I don't know. We end up with an expected ratio of 6.46 after it kind of comes down through the rest of the valuation. It's not necessarily super tied to like being at the midpoint of the range. It can kind of trail upward or downward depending on some of the other assumptions we already put in. But I think the 6.46 compared to the current 6.9 works and makes sense. Like I said, we expect a decline in sales, even though they very well might decline their capital base as well, but maybe not as much as the sales decline. So that makes sense. So taking a look at the returns on invested capital for the last 5 years on average, we see that it's about 22.5%. With the assumptions that we put into the valuation, we end up with 27% at the end of the 5-year period. So we are projecting with these assumptions that their returns on invested capital would increase, but not so much of an increase that it looks off to me. It's not necessarily a problem. Like I feel like there's an issue with the assumptions underlying the valuation. And so that means I'm pretty comfortable with these numbers. And then I did already adjust for defaults last night, and the only assumption that we changed here today was the short-term margin, so that really wouldn't change the default risks in the terminal year, so I don't think I need to adjust that, even though I did, like I said, make that kind of small adjustment here today. So we can get into the final summary for the valuation. Before I cover the summary and final, it'd be really appreciated if anybody watching, either live or on the replay, could give us a like. It's very, very appreciated when we get likes. It helps attract new people to the channel. And if you're not already subscribed to the channel, please do subscribe to the channel. That way you can get notifications when I go live. And join the Discord. You can find that link pinned in the chat as well as in the description below. You can join to get notifications when I go live, discussions, daily news, portfolio analysis, company analysis, random things that we discuss in the Discord below. So anyway, BCC, Boise Cascade Company, final valuation we have right here. The 10-year treasury is currently trading at 2.8, around 2.9%. I see that's kind of dipped up a little bit in the last 2 days after it's kind of been trailing down for the last couple of months. But anyway, mature market equity risk premium I currently have is 5.19%, and I come to a discount rate for Boise Cascade after adjusting for company specific risk of 9.67%. Their current the current dividend yield is 0.67%. As I had said, that is their small regular dividend, though they talk about regular expectations of doing special dividends, as well as they have share buybacks authorized. 5 years ago, they had sales of 3.9 billion or so against most recent year 7.9 billion. That gives them sales growth of 15% per year for the last 5 years or so on average. Sales to capital ratio, the 9-year rolling average being 5.64 against the industry expectation we have for them of 3.06. So very, very strong sales to capital ratio against their industry expectation. And the returns on invested capital, we saw them for the last 5 years having about 22%. Their debt to equity ratio is currently 18 to 19%, and they had a pretty typical about 1% default risk in the most recent year. The profit margins in the most recent year was actually 8 to 9%. This number feeds in from the basing space that we had, and obviously we had kind of played with that number, so that's kind of why that's showing the negative 2.59 per there. So you can kind of just ignore that. That's like I said, they had 8.9% against their industrial expectations of 10.5%. So they do have lower profit margins than their industrial expectations in the most recent year, but obviously they have a much more capital efficient business compared to their industry. And that gave them profit in the most recent year of $712 million against their current share price of $71.35. The probability distribution that we're using is our pretty typical, most commonly used distribution that is mostly regular, with it tilting a little bit more towards the optimistic fourth model against the less optimistic second model. But would you buy even though you own Interfor? No, but not necessarily because I own Interfor. This return just isn't good enough for me to grab at, and nor is the kind of differences between expected returns. I like the business, so I would, if it was at a good enough price. I wouldn't necessarily be opposed to owning both of them. I would just make sure I don't own a lot of both of them. And currently Interfor is still a very small position, so it's not so large that it would keep me from buying another company. So it's like, if I already built up a pretty good sized position in one other company, that would keep me from buying another company, but Interfor is still my smallest position. And it's probably going to keep growing slowly, even though yes, I am still buying it. So, you know, at this point, I wouldn't be opposed to owning both of them, because it would still be a pretty small position for both, and so I could kind of manage the position well enough. But like I said, this isn't good enough returns that I'm interested in purchasing it actually. So, but I'll keep an eye on it regardless. Anyway, back to what I was going with. The probability distribution gets us sales expectations of worst case scenario 4.9 billion in the 5-year forward period, to possibly a best case scenario of 10.6 billion in the 5-year forward period. On expected basis, we see 7.6, which equates to worst case scenario sales growth of negative 9% per year for the next 5 years, and maybe best case scenario 6% per year for the next 5 years. On expected basis, we see a little under 1% per year. Sales to capital ratio on expected basis, we see about 6.46, which means that we would see $6.46 of new sales for each dollar invested in the business. So that's basically what that means, is our capital efficiency ratio, giving us an idea of just how much revenue we can add to the business for amount of capital we add. Returns on invested capital on expected basis, we see 27%. So that's how much in total returns we would get back on the capital that we do invest in the business. And the debt to equity ratio, we see them possibly increasing their debt to equity ratio, whether it because their market cap comes down, or because we want to see them, or not want to see them, but because we project to see them conservatively financing more through debt, which is just one of the ways in which I typically am a little bit more conservative, is assuming companies will take on a little bit more debt as a result. That ends up with 23-24%. Their default risk, however, is pretty negligible as a result of that being less than 1%. Profit margins, we have a distribution of anywhere from 1% to 6.5%. On expected basis, we see a little over 4. And that gets us a profit expectations of anywhere from 49 million to possibly 689 million in the 5-year forward period. On expected basis, we see 320 or so million. And that gets us, with the discount rate that we're using for the company, an expected present value of $84.61, which is 18 to 19% higher than the current share price. We have 5-year forward value targets unadjusted for dividends that they could and will pay out during the period. And worst case scenario, $11.30 per share. Best case scenario, $331.68 per share. On an expected basis, we see $134.22 per share, which compared to the current share price gives us an implied return of 13.47%. And the value score that I have for the company, which takes in worst case scenarios and best case scenarios into account and compares it against the expected return of the market relative to the company's own discount rate. So kind of just comparing a lot of relative potential values within the company. I end up with a value score of 0.79, which if we compare that to the other companies in the list, I can see that the average value score that I have currently is 0.62. So it's higher than average. It's a higher than average company in terms of all the companies I have valued. The score I get for the index itself of the S&P 500 is 0.84. So it's perhaps maybe not as great of a specific investment to have than the S&P 500, though that partially comes off the back of the fact that the S&P 500 is diversified. And so this would be choosing an undiversified position. So keep that worth knowing. Doesn't mean that, like I said, I would expect Boise Cascade to have better returns, but it might be a better time to just own the S&P 500 is kind of what that means. But anyway, so it kind of puts it in league with other companies in the kind of this space here, around the space of Walgreens, Patrick Industries, Jefferies Financials, Sally Beauty, kind of in that range of companies as far as the current value scores I have, which again, all the rankings of the companies in my watch list have changed dramatically in the last year or two. If you missed the discussion I had at the start of the stream talking about how I have changed the way I calculate my beta measures over the last couple of days, I discussed that at the start of the stream, and that has dramatically changed my valuations herein, which I also said at the start of the stream I was going to post probably screenshots about that in the Discord after the stream today. So with that, that's basically it for the valuation today, and pretty much for the stream itself. I'm not entirely sure which company I'm going to be doing next on Tuesday. I am still waiting for Samphire Resources to release their annual report, and I haven't checked today, so I don't know, maybe it's waiting for me, but either way, I'm kind of waiting on that one, as well as I had discussed with the kind of refiguring of my watch list. There is also the companies that I'm kind of waiting for to update as well herein, which is to Micron Technologies. I'm waiting for that annual report to update, as well as Apple at some point in the next month or two will eventually report, and I need to update that valuation, but that's going to be some time off, as well as a couple other companies that have pretty outdated valuations in this watch list that might need valuing as well. So beyond that, I don't know if I can come up with another idea before Tuesday. I have a small short list of some other value stocks that I might take a look at, but in the meantime, perhaps people can leave comments for future suggestions. Let's see, I saw the last comment. Could you explain why debt to equity ratios change if the stock price drops? Thanks for the stream. Yeah, no, I'll be happy to explain that. It's because I'm using market value debt to equity ratios. Depending on who you talk to and what purpose it's being used for, you'll see people use book value debt to equity ratios, which is the book value of their debt versus the book value of their equity. But the specific metric that I'm using down here, debt to equity ratio, I'm using a market value debt to equity ratio. So it's the market cap of the company versus the debt to equity ratio versus the market value of the debt, which most people aren't even really aware of the concept of debt having a market value, but it does. It certainly does. Debt doesn't usually trade that differently from its market value unless the company is in distress. But you can take the weighted average maturity of debt and the weighted average interest rate of debt, as well as the book amount that it's listed for, to do a calculation to figure out what the market value of that debt is. So for Boise Cascade in particular, there is about $550 million in debt if you include lease liabilities as well. But if you look at the market value of that debt, it's actually only about 533 million. And so the market value of the debt is actually a little bit cheaper than the book value of the debt. And the reason why is because of the interest rate and, like I said, the maturity. And so there's a little bit of uncertainty that the debt won't get repaid. And so basically it means that the people who own this debt, if you could pay them 533 million today, they would probably take it. Or maybe they would want a little bit above that because they might want a premium above fair value, right? But the point is they would probably settle for less than 550 million if
if you gave them more than 533 million. So there's a market value of debt. So anyway, the debt to equity ratio is the market values of it. And so if the market cap drops, it means the debt to equity ratio climbs. And what that does is that increases the beta, which increases the cost of equity, which means that the risk of the company has gone up. So if the market, if the debt value goes up relative to the market, it means that there's a good chance that the market value is unrecoverable relative to the debt. Yeah, it's just one aspect of how I do the calculation. Like I said, a lot of people don't deal with market value debt to equity ratios. So you don't necessarily see that super common. You can certainly look it up. Like if you Googled for market value debt to equity ratio, you'd find the concept I'm talking about, but it's definitely not as common as using book values. But I think it's the best metric to use, especially for discount rates, which is what I'm using it for. There are other things that you sometimes want to use the book value for. Sometimes book value is the best metric to use, but for discount rates, which is supposed to be reflective of risk, I think that the market value is the best. So anyway, that's going to do it for the stream today. I appreciate the good discussions we had in the chat and the questions. Always like having people here to chat with. Otherwise, it kind of feels like I'm talking to myself. So anyway, I'll catch you all again on Tuesday. As I said, I'm not 100% sure what we're going to be doing for that stream, but I will probably figure that out within the next day or two and post a notification about it. So I'll catch you all again next time. Bye.